Well, let's move on to the Satrix Resi, an exchange-traded fund registered in South Africa. Market cap here, 259.5 million rand, dividend yield of 4%. Byron, is this a popular ETF?
It is fairly popular. The problem with this one is, if I'm correct, is it's the growth points and redefine are the big constituents here.
No, this is the resources one. So this is the Resi 10.
Resi.
Yes.
Sorry, I
Resi
misread that,
10.
yes.
So this is,
but that's even worse, actually, because Billiton and Anglo make up 80% of this whole index.
and of course in the hot stocks portfolio we have no exposure to resources, and we haven't had for a long time. So we've called the resource cycle correctly.
Yes, and I think I wanted to highlight that through this choice is that one looks at the name of the ETF, Resi 10, and you think, oh, I'm getting a nice diversified exposure to the South African or the JSE listed resources shares. In reality, after Sasol was reclassified from a resources stock to an industrial stock just now in March, now suddenly you've got Anglos and Billiton making up more than 80%, as Byron quite rightly pointed out. So suddenly
bye
this is not
diversification.
Absolutely, absolutely. You know, so if you are bullish on Billiton and on Anglos, go for this. If you are not, then stay away from it. It's as simple as that.
Let's just revisit our view on Anglos and BHP. It's a no-go area for us right now.
Yeah, we're not very bullish on commodities. I think, it's going to be very bouncy and volatile going forward. So for your average retail investor, it's going to be quite a wild ride. When you have a look at what the Billiton management team are doing at the moment, they're trying to simplify their business, looking at the core pillars commodity-wise. So by buying into this ETF, you all of a sudden making everything so complicated and you've got little exposures all over the place. I don't know. If you want exposure, I'd rather stick just with Billiton, but avoid.
Narina, your over or underlying view on the resources right now?
I'm also still very cautious on resources. I think there's still supply glut. There's an oversupply in most of our major commodities, and I think that's probably a situation that will continue for a while. For me, the Satrix Resi 10 represents a very good trading ETF. So this is not something that I will necessarily invest at this stage for the long term, but because it's so volatile, it presents some quick trading opportunities. And because an ETF comes with the guaranteed liquidity, so there's a market maker sitting behind it. So
you can get in and
out at the NAV. And that's very powerful. So you don't have to sit and wait for a counterparty who's prepared to sell to you at your price or to buy from you. It's guaranteed liquidity.
But doesn't the market maker take a bit of a cut?
They do. But it's no different than your bid-offer spread that you've got on your underlying shares anyway. So yes, there is a bid-offer spread, but I don't think it's onerous at all. I think in the case of the Satrix Resi, it's less than 20 basis points or 0.2 either way. So I don't think that's onerous.
When you look at ETF costing structure, you do have to consider that as one of the costs.
Do you consider that when you invest in individual shares?
I don't want to go into that because I think and I'm saying exactly the costs associated, and I'm saying from your perspective, Byron, I think that you may come out on the losing side when it comes to active manager fees. You want to go into that discussion now?
No, but I think the bid-offer spread is a reality, but it's a reality for anything that is listed on an exchange, and that goes for individual stocks as well as for ETFs. So there's no difference between the two.
Just on that point, we may as well bring it to conclusion. I've always been under the impression that it is cheaper to go the ETF route from a cost perspective. Is that right?
Most definitely.
Well, that's the big selling point.
Exactly. So let's go back now. I just wanted to ask one more question on the resources. When do you think, what is the red flag to buy? Because at some stage these stocks are going to get cheap enough for people to start taking notice and think there's going to be a change in even just the demand-supply equation.
For me, the change is going to come from the supply side, not from the demand side. I'm not expecting economic growth worldwide to suddenly start picking up and to suddenly become this big engine of demand. The supply side needs to be pulled
constraints
back
when it comes to
significantly.
supply.
Absolutely, and we might find that is different for different types of commodities. So quite important to look, are you looking at base metals or are you looking at the oil side or even agricultural? It's all about supply side, and for me that's the key issue to watch.
Byron, you're not looking at this theme anytime soon, are you? The resource theme.
I agree 100% with Narina. It's coming from the supply side, and we often say in the office that a long on commodities is almost a bet against human innovation. And we've seen that firsthand. The innovation amongst fracking and the big gas boom we've seen in the US has created created, you know, the big drop in the oil price. The innovation in terms of supply and efficiencies in the massive, big scale iron ore mining in Western Australia has also pushed that supply. So I think these businesses are still going to carry on being extremely efficient on the supply side, and I don't see any, you know, pushback in terms of the price.
Satrix Resi, hot or not?
Not for me at this stage.
Byron?
Not hot.